Let's fast forward a bit to, say, 2026. After the initial crypto chaos has kind of settled down and Bitcoin has really grown up into a serious asset. Today, we're going to pull back the curtain and see how the professional fund managers, the big money, are actually thinking about and using Bitcoin. So forget the hype, this is the pros thesis.
And this right here, this is the core of it all. See, professionals have stopped looking at Bitcoin as just a cryptocurrency. For them, it's a hybrid. It's part technology, it's part money, and it's part a hedge against all the crazy stuff happening in the global economy. If you can wrap your head around this three-part identity, you've basically got the key to its entire role in modern finance.
So what does being a hybrid asset actually look like? Well, in a portfolio, it means Bitcoin is now playing 4 really distinct roles. First up, it's digital gold, right? Gold 2.0, a store of value. Second, it's a global macro asset, just like oil or major currencies. Third, and this is a big one, it's becoming financial collateral, something huge institutions can actually borrow against. And finally, it's a whole separate monetary system. Each one of these is a pillar holding up its new identity.
All right, so here's our game plan. We'll kick things off with its new identity and the fundamental pillars that support its value. Then, we're going to look at the institutional engine that really changed the whole game. After that, we'll weigh the bull versus the bear cases, and we'll wrap up with the actual playbook the pros are using right now.
This whole shift from being just a cryptocurrency to this complex financial asset, it's not just talk. It's not just a narrative change. It's actually backed by some incredibly powerful fundamentals. So let's start with the most important one.
So, what is this entire professional thesis really built on? It honestly boils down to 2 absolutely non-negotiable pillars of value. And the first one, well, it's the one everyone knows. It's absolute, unchangeable scarcity. 21 million. That's the magic number. And that's it. This isn't some promise from a company. It's pure math, baked right into the code. That hard cap makes Bitcoin one of the very few truly scarce assets on the entire planet. And man, is that a powerful feature in a world where money is printed nonstop. But the scarcity story gets even more interesting. It's not just about the total supply of 21 million. It's about how much is actually up for grabs. Get this. A staggering 72% of all Bitcoin hasn't even moved in over a year. That tells you something huge. The vast majority of people who own it are treating it like digital gold. They're locking it away for the long haul, not just flipping it.
And when you put those 2 pieces together, you get this incredibly simple but powerful equation you see here. You've got a tiny, shrinking supply of coins that are actually for sale, and at the same time, you have this new wave of demand coming in. Basic Economics 101 tells you that creates a powerful, structural upward pressure on the price over the long run.
So, we've covered the super tight supply. Now let's talk about the other side of that equation, the demand. Because that demand has a new, massive driver that just didn't exist in the early days, and that is the institutional engine. This is when the big money finally showed up and completely changed the game.
This slide really just shows you the before and after perfectly. The old market, over on the left, that was a retail-driven roller coaster. Think extreme boom and bust cycles. Today's market, though, on the right, it's dominated by ETFs and professional funds. The volatility hasn't disappeared, of course, but the cycles are now longer, they're more controlled, and they're tied directly to what's happening in the global economy.
And this institutional adoption has woven Bitcoin into the very fabric of global macroeconomics. Professionals now use it as a hedge against inflation and currency debasement, and because of that, its price is now connected to all the traditional forces like interest rates, the strength of the dollar, and just the overall amount of money sloshing around the globe.
So, given this new reality, how do the pros actually map out the future? Well, they don't just hope for the best. They game out both sides. The bull case, all the potential upside, and the bear case, which has some very real risks. So let's break down what each of those scenarios actually looks like.
Okay, on one hand, you've got the bear case. This is mostly driven by a tough economic environment. Think high interest rates, a strong dollar. That could pull money out of those ETFs and lead to a period of consolidation, maybe somewhere between $50,000 and $70,000. But then, on the other hand, the bull case is fueled by things like continued ETF adoption and a better economic picture, like falling interest rates. That could realistically push the price well into the $120,000 to $170,000 range, maybe even higher.
Okay, so you have those 2 very different potential paths. How does a professional actually manage this asset in a portfolio? Let's get right into the strategic playbook that they're using today.
Inside a professional portfolio, Bitcoin isn't just one thing. It's like a Swiss Army knife. It wears 4 different hats.
It's a store of value, like we said, digital gold. It's a macro hedge against inflation. It also provides diversification because it doesn't always move in lockstep with stocks. And finally, it's used as collateral, a high-quality asset that can be used to secure loans, making the whole financial system a little more efficient.
So to handle those wild price swings, one of the go-to tools in the professional playbook is dollar cost averaging, or DCA for short. And this is simple. It just means investing a set amount of money on a regular schedule, say every week or every month. This smooths out your average purchase price over time and really reduces the risk of accidentally buying everything at a market top.
So if we put all of that together, the professional strategy looks a lot like this. Step 1. Use fear as your signal to accumulate. See those downturns as opportunities. Step 2. Use DCA to build your position without trying to perfectly time the market. Step 3. Make Bitcoin the core of your crypto holdings, somewhere around 40 to 70%. And critically, Step 4. Have a plan to sell into euphoria. Take some profits when everyone else is getting greedy.
Okay, we've covered its new identity, its fundamental value, the institutional drivers, the whole professional playbook. After all of this analysis, what's the one single most important thing to understand about Bitcoin's role in the world today?
It's this. In the long run, the pros aren't just looking at Bitcoin as another number on a spreadsheet. They see it as something way more profound. They see it as a fundamental experiment and a potential shift in the global paradigm of money itself. And that is the ultimate lens for its future.